Good morning, everyone, and happy Valentine's Day. I hope this week is going well for you so far. Of course, it's only Tuesday, so that's pretty early. But wanted to give a little bit of an introduction for the week and to talk about some of the concepts we'll be looking into. And so I'll get straight into it. If you look at the transactions we've really reviewed so far in this course, most of the businesses would have been service businesses. A lot of the examples were consulting, types of businesses. So in that situation, if you were to hire a consultant, you're going to essentially be paying for the person's time, whether that be a professional service, accounting, or legal services or whatever else. You're really not getting a physical product, for what you're paying for, but you're getting the time, you're getting the expertise, and that's what the real value is. So when you go to record the revenue, of course, you're going to have a credit to consulting revenue or service revenue or whatever that case may be. And then your offsetting debit is going to either be to cash, which is kind of ideal, or to a receivable, which we then hope will one day become cash if we collect correctly. So that's what we've looked at to date. And then this week, we really try to shift into manufacturing and merchandising businesses. And so there you've got another step in the process. We begin with, the assets that we use in production. And so that becomes a cost of goods sold. So you think about it, you sell something and then you factor out the costs that were used to make a sale and then or to make a product for sale. And then your gross profit is the difference between your sales and your cost of goods sold. And then from there, then you factor out your expenses, which is what we've kind of been looking at previously, to arrive at your net income. But it's a good segue into an important topic that really any accountant or really any manager, frankly, should know, and that's the concept of break even. And I want to go through that now. So let me just share my screen really quickly. So let's assume that I sell one type of product. I'm going to get really creative here and just call it product. Okay. My single product, whatever that is. And we're going to assume, of course, that there is great demand for my product, whatever that would be. So whatever I produce, I'm going to be able to sell. And I'm going to say that my selling price for the product is $50 per unit. Okay. I'll make that. Okay. And then if I think about it, my cost of goods sold, which is also a variable cost, let's say that's $30 per unit. Okay. That tells me then that my gross profit or margin is the difference between the two, which means that for every product I sell, I'm going to make $20 worth of gross profit or margin. That's what my profit margin is going to be. Now, if I assume that selling price is constant, then if I want to increase my gross margin or my gross profit, I have to find a way to reduce variable costs. And so if I reduce them to $25 a unit, for instance, then my margin becomes 25. Now, why do I call these variable costs? Well, really, what's going to affect how much I'm paying in this area is going to be the volume that I sell. So for instance, let's say that I sell 1,000 units. It's $50,000. That also means that my expense is $25,000 and my margin is $25,000. Let's say then that this is 2,000 units, 100,000, 50 and 50. My unit percentages remain the same, but the thing that drives how much money I'm making and how much money I'm paying is how much I sell. It's a direct proportion to the volume. When I think about fixed costs or other expenses, these are costs that are not variable. So think about your rent. You know, if you paid rent for a building and it was $3,000 a month, for instance, it doesn't matter whether you sold 1,000 units, 2,000 units, 5,000 units, 50,000 units, whatever. Your rent is fixed at whatever that cost is. It is not affected by volume, and that's why we call it a fixed cost. So let's assume in this example that I have fixed costs in a month of, let's throw something out there. Let's say it's $15,000 or some period, whatever that may be. If I want to find out my break even, I simply have to divide that $15,000 in fixed costs. I divide that by my margin. And that tells me I need to sell 600 units to break even. And if I wanted to find out what it would be, if I wanted to make a certain profit number, say I want to make $10,000 in profit, then I have to up it to 1,000 units. Very simple calculation. When I was in graduate school, it was amazing to me how many MBA students could not calculate this. And it's, as you can see, it's a really simple tool. And so whether you're going into accounting or whether you want to be a manager or whatever you need to do, you need to be able to do this and understand why this happens. So I digressed a little bit. I had, I'm gonna move this down some so that we can, let's see here, let me add a few spaces. We can finish this out. So if I had remaining expenses in this situation, let's say over $10, then my net income is going to be the difference of the two, or loss. So in this case, I made 15 bucks, or whatever the case may be. And so that's really the difference, is understanding in this chapter that additional step where we're going to factor in, you know, how essentially we handle a merchandising business, because again, we are thinking about what it costs to produce something as opposed to just a service that we're going to provide. It's an additional step, but it's really important. I tell new managers this, especially when you're thinking about some type of production or merchandising business. It's really important to understand this type of analysis on the front end, because when you launch your business and how you price your product says a lot about your business. And, you know, to some degree, we have assumed that there's perfect demand for the product, but we know that that's not the case in business. And in reality, there tends to be kind of a proportional relationship. As price decreases, price increases rather, you know, supply would then increase as well, because demand is, or I should say quantity demanded is going to decrease. As price decreases, of course, supply is going to decrease because quantity demand is going to increase. And so we need to think about that a little bit. And, you know, perhaps if you're starting a business and you're trying to you're trying to provide a premium product or service, then don't compete with Walmart and try to be the low cost leader. You know, what's happening there is when you think about that margin, if you're reducing that top number, that selling price, and your variable costs are pretty constant, you're going to have less ability as a small business to diminish those variable costs. Now, one way that we can do that, though, is, and we learn about this in chapter 4, is if we have the ability to have purchase discounts. If you look at a purchase discount, if you can get something, if you can buy something sooner, typically within 10 days or so, you might be able to achieve a 2% discount. Well, a 2% discount on purchases or cost of goods sold is going to have a 2% increase to my margin, which means that my break even is going to happen faster. Now, what's going to affect that? We learned about it in the last chapter, and that's going to be your cash flow. If I'm having to borrow to be able to take advantage of some of these discounts, then I have a more complex decision to have to make. Is it worth the borrowing and the extension of credit, the payback I'm going to have to that to receive the discount? Maybe, maybe not. If I have cash available to do this, you know, then I can receive the discount on the front end. So I'll leave it there today, and we'll have some follow up this week. But I just wanted to get you thinking about this week and some of the things we'll be looking at, and to kind of prep for what's next. So thank you so much. Have a happy Valentine's Day and a good day. Bye now.